Welcome to the Paper Trail, where we follow the journey, my journey, through the world of a CEO of a mortgage note fund. I'm Chris Seveney, and after years of buying, managing, and selling notes with Seveney Investments, I'm here to share the real stories behind the deals. What went right, what went wrong, and what I wish I knew earlier. From non-performing loans to seller financing to private lending, this show is about more than strategies, about growing your business, learning to follow the paper trail, and doing the due diligence that separates the pros from the rest. Now, let's hit the trail running. $265 billion. That's the number Fortune put on it. The private credit market, Wall Street's hottest trade for the last 5 years, is starting to crack. Have you heard Morgan Stanley just restricted redemptions at one of its private credit funds after withdrawal surged? JP Morgan has pulled back on private credit lending after markdowns, and headlines are starting to use the word panic. Now, if you're a note investor, or if you've heard of Seveney or funds like ours described as a private credit fund, you might be wondering, is that us? Are we in that trade? The short answer is no. And today I want to explain exactly why that's the case, what private credit actually is, what's going wrong with it, and what makes asset-backed note investing structurally different. Now, this is not a sales pitch. This is a genuine explanation because I think there's a lot of confusion in the market right now and how investors deserve a clear picture. I'm Chris Seveney. This is the Paper Trail Podcast. Let's dive into it. First, let's start. What is private credit? And why did everybody love it? So let's set the stage and to understand what it is and what's breaking. First, you have to understand what private credit was supposed to be. Private credit is, at its simplest, lending that happens outside of traditional banking system and outside of public markets. No bank intermediary, no public traded bond. A fund raises capital from institutions, credit investors, and even some retail called BDCs, and then deploys it as loans, but they deploy it to mid-market companies, AI, tech, commercial real estate. That's the basis on where they're investing. And the pitch was compelling because higher yields in public bonds had lower volatility than public equity, and the illusion of stability because the assets weren't marked to market every day. If you can't see the price fluctuate, it feels safer. Now, after the 2008 financial crisis, banks pulled back from a lot of mid-market lending because regulations got tighter. Capital requirements went up, and that created a vacuum, a financing gap for businesses and projects that couldn't access the bank credit or the public bond market. Private credit filled that gap, and for a while, it worked well. Assets in the private credit market grew from about $500 billion a decade ago. Now it's north of $1.7 trillion. Apollo, Ares, Blackstone, Blue Owl, some of the biggest names in finance, built massive platforms on this premise. Some considered it the trade of the decade. So what had changed? Private credit market ran into the wall that every credit cycle eventually hits. And the damage is starting to show. So here's what's happening. These private credit funds, particularly those exposed to leveraged corporate loans, are dealing with a three-part problem, all converging at once. First, you got interest rates. These funds made loans when rates were super low. Many of these loans are floating rate, which means as rates climbed, borrower stress climbed with them. Companies and projects that could barely service debt at 4% now are choking at 7 or 8. That just like commercial real estate, multifamily, the rates go up. You're seeing what's happening. Second is markdowns. These assets in these funds haven't been marked to current market reality. When forced sales refinancing happens, the gap between the carrying value and the market value actually gets exposed. JP Morgan pulled back on its lending specifically because of markdowns. The collateral isn't worth what the models said it was. I got an email this morning from a bank that had no markdowns last quarter to like 100% markdowns on assets this quarter. Things just don't blow up that quickly. They're finally realizing it. And then the third aspect is the redemptions. Morgan Stanley restricted withdrawals at its fund after investors rush for the exits. It's a liquidity trap private credit has always had. Investors want liquidity like stock market in the behavior from an asset class, but when sentiment turns, the mismatch becomes a crisis because these assets truly are illiquid. Now, Fortune called it a panic. Morgan Stanley's locked the door. JP Morgan stepped back. I wouldn't panic. It's not a blip. It's a credit cycle playing out in motion. Now, here's where I want to stop and be really precise, because the term private credit gets applied to a lot of different things, and not all of them are in that same trouble. And Seveney, for example, we are not in that trade. And let me explain how note investing is not part of that as it gets mislabeled. And when someone looks at what we do, we raise private capital, deploy it into loans, earn yield, and they say that's private credit. And on most surface level description, sure, yes, you're right. We're providing credit outside of the bank system. Technically accurate. But that's like saying a pawn shop and Goldman Sachs are both in the lending business. Technically true, but completely misleading about the risk profile. Critical distinction. The one that matters in a downturn is this. What happens when the borrower doesn't pay? In a typical private credit, corporate direct lending, CLOs, most of the funds make headlines right now when borrowers default because you're unsecured, you're weakly secured, there's a group of first position creditors. It goes into a restructuring process. Lawyers get involved, negotiating with other creditors, and at the end of the day, they might recover 40 cents on the dollar or less. In note investing, asset-backed notes secured by physical real estate, as I always mention, I invest in things I want to go touch and feel. When the borrower defaults, you have the collateral. That's it. The loan is secured by first position lien on a piece of property. Legal process, very clear. And if you bought the note at a discount, which is how defaulted note investing works, the margin of safety is somewhat baked in from the day you close. I really want to say we're not in the same private credit trade, because when people hear private credit, they think they know what it is. And a lot of them don't. And the difference between what's cracking right now and what we do at Seveney comes down 3 words: asset-backed collateral. And let me be specific about the distinction, because these private credit funds are lending against cash flows. They're lending against a company's EBITDA, a projected revenue, income stream. Those cash flows are extremely fragile, and they disappear in downturns. They get revised down. They evaporate when rates go up, and refinancing costs eat into that margin. Again, what we do is we lend against real estate. It's a house. Something that exists in the real world, has a legal description, has a market value that can go up, can go down, but the collateral doesn't disappear when rates go up. It might decrease in value at the margins, but it doesn't go to zero. And because we're buying these defaulted loans that are already in default, they're already in discount, we're not underwriting to a perfect scenario. We're underwriting to a broken scenario and building our return around our resolution. We've got multiple outcomes that we model within our processes, and that's a fundamental difference in the risk posture that a fund that originates loans at par and has to mark them down to buying them already at a discount. And the funds making news right now are dealing with these assets that were priced for a very low interest rate world. And we're buying the assets already priced for distress. Really, it's not the same business. So I want to make sure the private credit covers both, but risk profile completely different. And we're just not in a private credit fund in the same way Wall Street uses that term, because we're asset-backed, real estate secured, defaulted note fund, collateral is real, discount is real, and the path to resolution is real. Now, I said earlier, there's something else happening in the note space worth paying attention to, something that's creating opportunity for investors like us. So let me take a minute and explain what we are seeing. And I call it the tech real estate sell-off, which is an opportunity in disguise. Because I've been watching this very closely and hasn't really been covered well anywhere. Over the last couple of years, new category of companies emerge in real estate. I describe them as tech first, lending second companies that build a model on the premise that these algorithms, underwriting, venture capital backing make them better, faster, more scalable than traditional real estate lenders. And they get into the note investing space. They're originating investor loans, the fix and flip, the bridge, the DSCR on these rental properties using tech-driven underwriting and packaging them into pools or having brokers originate them, and they're an aggregator collecting all these. The pitch to investors is seductive. Institutional grade access, tech-enabled efficiency, diversified exposure to real estate credit. And for a while during zero rate asset appreciation, the boom environment, numbers look good because you give somebody a loan, property values increasing, you're getting a nice coupon rate. But now what we're seeing is tech companies are selling off these loans. Distressed tech loans are hitting the market. And there's a category of these tech-driven lenders that are getting caught with their pants down in this rate environment and in how they manage their portfolios. We are seeing large sell-offs of their loan portfolios hitting the market. For disciplined note investors, it's not a warning sign, it's a buying opportunity for us. So what's happening to these companies? As I mentioned, they built their model on three assumptions that kind of all breaking at once. Rates would stay low, values keep rising, and underwriting could replace judgment that comes from years of working through distressed loans at borrower levels. Now, what are we seeing? Rates up, values softening, investor-owned properties where the math was already thin. People didn't have the revenue to pay these loans. They start going delinquent. And these companies don't have borrower relationships, workout experience, have no idea how to manage through it. The playbook was origination, not resolution. And these portfolios are hitting the secondary market in significant quantities. We're seeing huge pools of these loans, the fix and flip, the bridge, the short-term residential loans coming to market from these companies as they try and raise liquidity, restructure, in some cases, wind down. For a fund like ours that's specifically built to buy distressed notes and work through them and have that in-house asset management team, we work direct with the attorneys. This is an environment that we prepare for and what we've been accessing over the past year. We know how to evaluate these pools. We know what the resolution path looks like. We have the servicer relationships. We have the legal infrastructure. We have the asset management. These tech lenders thought they could automate their way through some of this credit cycle. And in good cycles, absolutely you can. But when things aren't on the conveyor belt and each asset has to be dealt with individually, they can't, because it requires judgment, relationships, patience, specific individual outcomes for every asset. And I want to be clear, their distress is not our distress. When we see these lenders have to sell a pool of loans at a discount, pool's got to go somewhere. And we have no qualms about being the buyer if we can buy it at a great price. Now, I do want to say not all of these loan pools are equal, and I want to be clear about that. Some of what's hitting the market is generally impaired. Borrowers in markets where values have dropped significantly, loans with thin equity cushions, properties that need the work that borrowers couldn't fund. We're not buying everything. We are extremely selective. The question we ask on every pool is the same question we've always asked. What's the realistic resolution value? What's the price do we need to be at to make the math and the numbers work across every scenario? If the discount is big enough, even a messy loan has a path. If it isn't, we pass. Got a loans that sent to us the other day. We bid at about 40 cents on the dollar. They came back at 70, And the joke from the individual who passed that information along was that, it's Friday the 13th. So I mention this because there's a lot going on. And I just want to wrap everything now together because you're going to hear the private credit market is cracking. The headlines are real. 265 billion in stress, redemption gates at major funds, markdowns, JP Morgan, all these large Blue Owl, growing concerns from analysts who spent years, everyone, this is the safest trade in finance. The reason it's cracking is structural. Funds that were priced to perfection, lent against cash flows, promised liquidity, they couldn't actually deliver. And now they're discovering what every credit cycle eventually reveals. The old Warren Buffett, when the tide goes out, you see who's wearing a swimsuit. But here's what I want you to take away from this. Not all private credit is the same. The label covers a huge range of strategies with different risk profiles. Asset-backed, real estate secured, distressed note investing. It's not the same business as corporate debt, direct lending, investing in these AI companies. Collateral is so different. The discount is different. The resolution path is different. Right now, the stress in other parts of the market is creating deal flow for our space. And we see it with some of these tech-driven lenders who built these platforms to originate and aggregate. And if that supply is at the right price, that is the opportunity. And I just want to reiterate, at Seveney, we've been doing this through multiple cycles. We were built for this environment. We're not just able to survive it. And I think that's a different posture than what most of what you're reading about in the headlines is right now. If you want to learn more about how we think about credit, what our underwriting tools look like, what we're seeing in the market right now, check us out at seveneyinvestments.com. Link will be in the show notes. Happy to talk to you and walk you through it. We have a lot of webinars and education in regards to what we do, what we focus on. I hope this episode did give you a clear framework to think about private credit and the differences and how it's involved with note investing. Please share it because there's a lot of investors right now trying to figure out how they're being impacted. And we wanted to provide a clear picture. I'm Chris Seveney. This is the Paper Trail Podcast, and I will catch you on the next one. Thank you all. Thanks for joining me on this episode of The Paper Trail. I hope today's insights help you sharpen your note investing strategies. If you found value in this conversation, subscribe, leave a review, and share it with fellow investors. I'm Chris Seveney, reminding you to keep doing the work, trust the process, and always follow the paper trail. Until next time.